The wealthiest generation in history is starting to retire and die. In doing so, they will be responsible for the greatest wealth transfer in history as they pass along a collective $30 trillion to their beneficiaries over the next few decades in the United States alone. So whether you're coming to the end of your journey or getting ready to live that easy life off the back of the hard work of your parents or grandparents, stay tuned, because nothing in life is certain except death and taxes. And I'm going to tell you how to cheat one of them. No, not you. Let's do this. If you're thinking this video is just for the very wealthy, think again. If you have assets worth over £325,000, you could be liable for inheritance tax. And with the inheritance tax rate being a whopping 40%, I'd bet you'd rather not.
Now, 80% of people believe that IHT planning rules are too complex. So I asked estate planning expert Oliver Cooper to help me put together a plan that will help break it down for you.
As Oliver likes to say, inheritance tax is a voluntary tax. It's only paid by those who don't plan for it.
Now, before I jump into the steps, there are a couple of things you should know. First off, the standard IHT rate of 40% is only applied above the threshold. The threshold for a single person is £325,000. The threshold for a married couple or those in a civil partnership is £650,000. Finally, between a married couple, if everything passes to the spouse on first death, then there's no tax to pay.
With that out of the way, let's dive right in with step 1.
Gifting monies.
There's no limit to how much you can gift, but there's a 7-year rule. If you die within 7 years of gifting your assets, those assets will be liable for tax. You can give away up to £3,000 per year tax-free, and the thresholds still apply to gifts above that. Now, before you get too excited, there are strict conditions on gifting.
The person gifting the asset cannot retain the benefit of the asset going forward. If you do, HMRC will include it in the estate calculations for IHT purposes. In other words, if you give the kids a house, you can't continue to live in it. Step 2, gifts out of income.
This has to be from disposable income, has to be on a regular basis, and cannot affect your standard of living.
For example, if your disposable income was £60,000 per year and your outgoings were £30,000, this would give you an excess disposable income of £30,000 per year. This excess could be gifted without being subject to the 7-year rule and would be exempt from IHT. Step 3, convert your ISAs.
You can convert your ISAs into inheritance tax exempt ISAs.
Step 4, take advantage of BPR.
That's business property relief. Making investments that attract BPR will reduce your IHT liability.
Step 5, take out whole of life insurance.
This is probably the second best step you can take behind step 7. You can take out a whole of life insurance policy that upon your death pays the tax bill so your children don't have to.
Yes, you'll have to spend some money up front, but depending on the size of your estate, it could be well worth it. Don't risk cheaping out and throwing money away to HMRC.
Before I share step 6, let me get this out of the way.
This video couldn't have happened without the help of Oliver Cooper over at Foresight Estate Planning. I don't know shit about IHT, so I asked Oliver to help out with this video in return for this segment. Oliver is the absolute expert when it comes to estate planning, and if you have a sizable estate and need IHT planning help, then give him a shout. If you want help from him, you will have to pay, but remember that good advice pays for itself 100-fold. Step 6, marital status.
Now this could backfire, so I leave it to your discretion. But if you're in a long-term partnership and haven't tied the knot, consider doing so for tax purposes. There's nothing more romantic than saying, honey, will you help me reduce the IHT bill?
Remember what I said at the start of this video? There's no tax to pay between a married couple or those in a civil partnership. Step 7, tax planning wills.
Passing your estates directly to your children could increase their estate for inheritance tax purposes.
Whoops! You've just given them the same issue you had when it comes to passing the estate to their children and avoiding IHT.
A direct inheritance from parents means the children's inheritance will not be protected should they divorce, go bankrupt, or die before their partner. Your best bet is to use a trust.
By passing via a family trust, the inheritance does not increase your children's estate for IHT purposes.
The family trust also protects the inheritance from being taxed through each generation and protects the money in the event that your children get a divorce or go bankrupt.
In my view, this makes it by far the best step you can take to reduce your children's IHT liability.
Again, it's something that'll cost you, but we're talking about spending a few £1,000s in order to save hundreds of thousands. This isn't the time to be cheap.
Well, those are my 7 steps to minimizing IHT in the UK. I hope you found that useful. Bear in mind, paying the standard rate for IHT can have a devastating impact on wealth over just a few generations. And the biggest mistake you can make is not getting professional advice. So, if you're not going to take IHT planning seriously, at least make sure you spend all your money before you die.
It's gotta be against the law to look this damn good.
And on that note, leave a comment below and let me know if you found this video helpful. That's a wrap. Wait, what are you doing here? Seriously? Well, that sucks.